Happy Father's Day, everybody, and welcome to this week's edition to my top-down review. This is Jeffrey Scott, for those who haven't been here before, and my email address, as you can see in the lower right, is hgsidoc@gmail.com. If you have any comments, questions, positive or negative, please feel free to comment, and either comment if you're watching on YouTube under the remarks, where you can add commentary. If you like this, thumbs up is great. If you don't, thumbs down sends me a message. And subscribe, because I don't have a mailing list. I don't get anything if you subscribe, because with a few hundred people that watch this video on YouTube, they could care less about me. But I do this for you and not for YouTube. I've been doing this for, 20 years plus. I try and do them every weekend. I've been through a lot of up and down markets. I've been trading for over 30 years. Trading is a big word. I'm more of an active investor. I work full time, and thus I'm not one of these people that are in and out of the market every 30 minutes. I titled today, Market Has a Taper Tantrum, harkening back to 2013, and I think a bounce may be close, but beware of further downside to come is my title. I start with a PowerPoint presentation that takes a lot of snapshots from different programs that I use, and I start and spend a lot of time on the market because, frankly, the market's where it's at, and whether it's 50%, 70%, of whatever it is, the majority of what happens this week is driven by the market and not your stock picking. As always, this is for educational purposes only. I'm a doctor, not a broker. I'm independent. I pay for the tools that I use, and trading involves risk, and you alone are solely responsible for any investment decisions you make. At one point, when I was retired during a non-compete, I did some live education, and the purpose of this slide is not to show you who I like, although it's obvious because they're up here, and I've got some more I might be adding soon, but it's really to talk about my journey. I'm a physician. I've got no business background. I started doing this by going to seminars. I met this guy, Ian Woodward, at a Telescan seminar. I read O'Neill's book. I got friends with smart people like George Lee, John Person, and Sagar down here. And I've taken what I've learned from so many smart people, whether it's from reading, doing, watching videos, going to live meetings, and I came up with my own style. And I think each of us needs to become our own guru and not rely solely on third parties. No one cares more about your money than you and your family does. I own a lot of software. I'll look today a little bit at TradeStation and Thinkorswim. I use HGSI predominantly for my analysis. During the day, it's a little clunky, but you can do updates very quickly using Thinkorswim. After hours, it's the best program. Why is it clunky? Because it doesn't automatically do streaming quotes. Other than that, wow. EdgeRater supplements my analytics that I do with HGSI. And then I use John Person's tools, Dr. K's tools, Sagar's Q tools within TradeStation, Thinkorswim, or in HGSI. I'm an unpaid volunteer. This is just education. Here is the website for the software program, highgrowstock.com, commonly referred to as HGSI. Again, I have no financial relationship with anybody, including George, who runs HGSI. Just a big fan. Free 30-day trial, you get an opportunity to try the program out. It's got a little bit of a learning curve, but I have some videos, Ron Brown has some, that can help you get moving quickly. So if you're a new user, feel free to ask, and I'll send you some of my supporting material. Under trading strategies, you'll see videos like this from myself, Ron Brown, and others. I've been doing these for a long time. Stock patterns are cyclical. It's really easy when we're in the circles. When the market's been doing nothing for a long time, or it's had a sharp pullback and it reverses with huge amounts of momentum, it doesn't take too long to realize that we're in a stage 2 markup and it's time to buy, buy, buy. When the market's clearly rolling over, cleanly, lots of signals, you know it's time to sell, you know what to do. The problem is when you're in chop, and we've been in chop for some time. So really what we've done is we've taken off the top of this and we're kind of doing this. Every time it looks like we're going to roll over, we get a move to the upside. Every time it looks like we're going upside, we fall. So it makes it a very, very difficult time. And there's a reason why so many pundits say that choppy markets will chop up your account. So I'm going to say we're still up here in uncertainty. It feels like we're rolling over, but I just wonder if we don't have one more charge up, maybe to trap some bulls before this market rolls over. Because of this uncertainty, I have raised cash, I have smaller positions, I have sold premium, and I'm not taking risky plays like the Scott synthetic. I don't mind going long a call. I don't mind going long a put. I don't mind doing verticals, but using a short put spread to pay for a long call in this environment is probably not the best use of your capital. If we look at this environment and we look at the market close on Friday, you can see what Ian used to call a sea of red. I'd like to point out the strength, but there really isn't much up there. You know, I got saved because I do own some HubSpot, and between that and some of my other big cap techs, it wasn't a horrible week, but boy, was it a difficult week for the market as a whole. If we want to look at the major markets, so let's go ahead and let's pull these up. I believe this is the right one. Here we go. And let's open up here. Make sure it's daily, it is. And let's just quickly look at the daily. So this is the 170, 168% extension off the March low. And 162%, whatever. And what I've been pointing out over the last several weeks is we're just going sideways. We're going sideways at this fib extension. And even though we get a few teases where we break up, we come right back down. Well, we've done it again. This time we've actually broken below, this is the E-mini futures, the 50-day moving average. We're in a person sell signal as of Wednesday. And when you look at this, it doesn't feel real bullish. Now, do you want to short here after such a big drop? You could, but I'd rather see the market try and move up and fail at the 50 before I start entering a lot more shorts. If we look at the NASDAQ futures, do not look as bad. The NASDAQ has not broken down below the 50. The NASDAQ is still in a John Person buy signal. Heck, the NASDAQ hit an all-time high on Friday before the market rolled over. So the NASDAQ gave it up, but the NASDAQ is still in the upper part of its range. If I look at the Dow futures, let me give you some more. The Dow futures, oh, this was painful. The big Dow stocks just rolled over, and look at 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Looks like about 10 red bars in a row. Now you go look back on the chart and tell me over the last year, when is the last time you saw 10 green or 10 red bars in a row? It just doesn't happen very often. And, you know, I look at this and clearly we probably have a snapback coming. Now, again, does it mean we're out of the woods, or do we run up and fail again and now you have a new time to short? I'll take that idea. I don't think we quickly go up to new highs. And how much work is it going to take to get through this 50? Remember, what's been basically support on the way up might become resistance on the way down. I look at the Russell futures. I think we're still kind of in the sideways box here. We did break down below the 50, which is disappointing, but we've been doing that with regularity. So lower part of the range, person sell signal, definitely not strong looking, tough week on the Russell, but have we broken down? Not as bad as the diamonds and perhaps the spiders. So the strength of this market right now is the NASDAQ. If we look at the VIX, you can see the VIX had a big move up this week, taking out the 50 daily. I think it was up, I heard some people say 16. I think the VIX futures here on my charts, on the futures, were up 10 or 11%, but a big week. Now, we still got to get above this 200 to be meaningful, but the VIX is in launch mode and did have a buy. Not good for the overall market. And the other thing that's in launch mode, taking out the 200-day moving average, is the dollar. And the dollar is king right now. Flight to safety from overseas. Is it because our economy is getting better? Is it because the Feds suggested they're going to start tapering sometime sooner or later, and rates might be going up sooner than people thought? Regardless, a strong dollar will have some impact on your portfolio. Not all good. Not all good. Now, we'll look at the weekly, but I'm not sure I'm going to add a whole lot with the weekly. If you look here at the weekly, you just get a sense of how much we've fallen or rose from the March lows on all of these indices. And, for the most part, we've just gone sideways up here. So are we overdue a correction? Probably. Do we definitely have one coming? Are we in the midst of one? I think we might be, but I think we've fallen so far to see a little bit of a rally at some point this week, and I'll give you more evidence for that as we go. It's potentially in the cards. Now, the expected move charts this week were really fascinating. And remember, the expected moves are an at-the-money straddle as calculated by the option market makers. So think about it. They're going to sell you a call at the money and sell you a put at the money. So you're going to, as long as the stock stays within a range plus or minus the combined premiums that you pay, the market makers make money. So for you to make money, and let's say each of the premiums are X, the market would have to move one way or the other more than 2X. So you have to figure that the market makers are really about risk mitigation and management of money. So they're pricing these so that's in their favor. And it's true that over 60, 70% of the time, the price will stay within the expected range. Now, typically, I look for reversals when it gets outside the expected range. And when that happens, I look for opportunities to buy the bounce. But it's also possible that we'll blow right through the expected range and still go. So I just don't buy the breakdown, I buy the recovery. So I don't know what to say about this one here. It's a mistake, but that week the market didn't move. This past week, we really on the S&P 500, sideways on Monday and Tuesday, and then broke down the rest of the week and actually closed below the weekly expected move. So that means the market makers might have lost money on the E-minis. The NASDAQ futures, on the other hand, right in there, and actually since they had such a weak day on Friday, they closed just above where they opened on the week. So again, selling premium is a good thing in this scenario, and you probably expired at least one side out of the money and with a losing trade even on the side that was in the money. If I look at the Dow, whoa, look at this. The Dow, here's your 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days in a row. And let me get this right. 1, 2, 3, 4. All right, so it opened below where it closed the prior week, and each day a lower low and a lower high. That is very bearish looking, and no sign of a bounce or a recovery here. Not even a tail on Friday suggesting bottoming. That's how weak this the Dow is. Now, no shocker, this is a negative divergence sign. It doesn't even paint the, I think it's a MACD histogram. But we had negative divergence prior to this breakdown, and here was a shooting star that really was the end of the market. Now, notice a pullback and a move back up, but not up to where we topped at. A number of indecision days and then a breakdown. Now, I would rather be shorting up here than down here. And I wouldn't be surprised if we see, similar to this, a bit of a recovery and a rollover. So this is the Dow on the expected move. The Russell expected move, just like the Dow. It's only got 5 days in a row to the downside. But wowza, closing at the low, no signs of a reversal. This is a reversal to the downside, and then it's not quite a railroad track that reversed it, but this is when I get interested. And clearly I would have been in or was in the market when it took out the high of that reversal day. We don't have anything like that. That's to me a very ominous picture. It might paint the bearish case. Well, also painting a bearish case is the VIX going up all days except one and closing outside of its range. And lastly, the dollar marched up, and look at these gaps. And this is the UUP, it's an ETF, not the future. Strong dollar. So I guess if you're not a little bit worried about this market, hopefully I'm making you think that way. Rates fell. I think this is interesting because if inflation is up and the Fed's going to raise and reduce easing and the economy is so great, why are rates falling? I heard all kinds of explanations. I still don't know the answer. Maybe it's because people are, or at least the ones that know, who are influencing this, are in the camp that this inflation is transient. I hope so. I just paid $4 a gallon for gas down here, which might be cheap from California, but I was paying $2 2 months ago. AD lines have pulled back from all-time highs. It's hard to see this. Maybe it shows better on your computer. The white is the AD line, the Russell 2000. Here's the 1000 on the right. The IWM is kind of light here, the IWB, the big caps. And both the AD lines and the prices pull back. You can see it better here. Look how strong down the AD line was on the NYSE. Interestingly, the one thing that's divergent there is the Qs. The Qs showing some resilience in the setting of a bad market. And with rates falling, not a big shocker, we see the TLT rising. Now, breadth, also concerning. Long-term breadth held. You can see we're still with a lot of stocks trading above their 200-day moving average, but you can see the stocks above the 40 drop. So now we're back to a point where most stocks are sitting in that land above the 200 and less than the 40. What worries me, or not worries me, makes me think that we might be getting oversold enough that we might be approaching oversold territory is the T2121, which is a 3-month new high, new low indicator. Kudos to Sagar, who's built this into his Metastock stuff. I know those that use HGSI are probably getting tired of me talking about Q's Metastock stuff. And frankly, I'm tired of talking about it too. I wish it was Q's HGSI stuff. But according to Sagar, who I've spoken with extensively about it, he gets a lot of data out of Metastock that HGSI wouldn't have. But here we are looking at TC2000, And if you start to look at some of these reversals, they usually are associated with a reversal in the market. So we can get a whole lot lower, but we're approaching areas of oversold that have seen a bounce in the past. The other thing that I thought was interesting is the daily McClellan. If you look at the oscillator, look, we're looking for extreme readings. We're looking for divergence of price and either oscillator summation index or zero line rejects. We have pulled into a line. It's not the extreme line that we saw of March 2020, but it's where every correction on this way up has reversed. If you want to be long, put that feather in your cap. Buckets. So for those that are new to me, this is such a cool, simple idea. The buckets say, let's take every stock in the S&P 1500 and let's look at their chart and where are they within their Bollinger Bands. Let's take those Bollinger Bands and divide them into 10 buckets, the 0 to 10% percent B, the 10 to 20, 20 to 30, and so on and so forth. Let's make an 11th bucket, or we'll call that -0, if the stock is below the band, and let's make it a greater than 1 if it's above the band. Now we know that 90% of the time the stocks are going to stay within their Bollinger Bands. They're volatility bands. They're designed to capture the majority of a movement of a stock. So I think we can agree that if a lot of stocks are below the bands, then the stock market's probably getting oversold and the stock's going to correct this by going back in the bands or rise. And if there's too many stocks above the Bollinger Bands, we're probably overbought and we're going back in. So I hit a button. I don't have to look at the charts. And what did I find out? 79% of the stocks in the S&P 1500 are below the midline, pointedly bearish and substantially worse than a week ago. And then the other thing that's interesting is over 40% of stocks in the S&P 1500 are below their Bollinger Band. So for some of us, that makes us think the market's likely to rebound. Now, I used to do my own research, not just use Ian's research, back in my in-between jobs time. And I remember doing this chart before one of my live meetings and basically demonstrating what tops look like, mostly green on the pie and a lot of stocks above the Bollinger Bands, and what bottoms look like, which is a lot of red in the pies and a high number of stocks below the Bollinger Bands. So we're not at the point of guaranteed, but most of the time when we get this far shifted to the left and with these many stocks below, we bounce. Now, that's not a guarantee. Not a guarantee. Let's go back to an unhappy time when I was doing these. God, 12 plus years ago, I was doing these. And this is going back to, this is 2008, 2009. So 13 years ago. And what I did is I asked the question, how much lower can we get? And you can see the dates here. Sequential dates starting, looks like 10-3, 4, must have been a weekend, 10-7, 10-8, 10-9, and 10-10. And what I wanted to show you is that just because a market is oversold doesn't mean it can't get more oversold. Do I think this is what's going on today? Absolutely not. But I'm going to trade the market I get, not the one I think we have. So I have to remember that just because I'm certain that with 40% or more stocks below the Bollinger Band, we're going to rebound. We had over 70 on this day and over 70 on this day. And then the market started to recover. You can notice that we started to fill in some of the other buckets. HINDY free zone, Hindenburgs typically occur in a setting of new highs when you have the pros selling to the amateurs, signaling a market top. We do not see a Hindenburg omen. We haven't seen one in months. You can look over here. This is how EdgeRater calculates it. If we look at the market tone, we're looking at this column here, which is the Woody indicator, and just very qualitatively, we had a bunch of kahunas to the downside Thursday and Friday, and that shifted the market out of a bullish neutral to now more of a bearish to neutral stance. More bearish than neutral. How bad was it last week? Well, it was pretty god darn awful. On the left is an edge rater report taking the fundamentals in the market 1 week ago and then walking forward with actual market performance and asking the question, how did growth do? ERG is EPS rank, relative strength rank plus group rank, ERG, and typically growth stock investors deal with high ERG stocks. Now, this gray thing here, and this is the scale, tells how many stocks are at each place. Well, I don't even look at anything before this point or after this point. So I'm really looking only at this part of the curve. And what do you see? You see that everything was negative on the week, and some of the growth names were down 4%, 6% or more. So it was a pretty challenging week. Some of these stocks were down 14%, but very few stocks were in this group. EPS rank versus gain, it's all negative. You have less loss with more earnings, kind of sorting, really not very good looking. Yet if you look at relative strength rank, the higher your relative strength, the more you got punished. The better your group rank was, the more you got punished. A very disheartening week. Now, I had some stocks that have been doing well, especially HubSpot really kicked ass this week. SE had a great week this week. So when I look here in orange, I see the S&P was down a little bit over 2%. That's a pretty tough week when the S&P is down that much. In yellow, I've got a bunch of the Investors Business Daily indexes. IBD 50 was flat. The IBD Live Ready List was down 175. The MarketSmith 250 was down 2.7%, and your weekend review was down 3.7. In green, I'm happy to report that I was up a little bit on the week. Most of my stocks were down, but because of some big ones that did very well, I did okay on the week, not great on the week. My buy watch was also down minus 1.68, similar to the Ivy Live Ready. My filtered buys was down 0.83. This was a tough week for growth. Now, I did have some shorts, and somewhere down here will be my shorting candidates. If they're down minus 3.58, that means my short portfolio was up. And notice of my 10 potential shorts this week that I took when I picked last weekend, all 10 were to the downside. Well, that sounds great, but I still had a long portfolio too. That's partly of what salvaged my my week. Sector strength, you could see a lot of red here. It's deteriorating. How bad was Friday for the bulls? Well, on Friday alone, we went from 38 above the midline of the SP 1500 to 22. This is Sager's edge tool. You could see 78% below the band. And look at the change in one day. 8.1% below the lower band on Thursday and over 40% on Friday. How great is that because of Sager, I can do this real time during the day, and I don't have to do anything except start a spreadsheet, and it populates by itself. The other thing to point out, and we don't have real time because we're not open today, one day ago is Fridays, all 11 S&P sectors were negative on Friday. 100% sectors were negative, 98% of industry groups, and 91% of stocks. That is a weak, W-E-A-K, weak, W-E-E-K, ending. So if we look, here is Friday, here's 2 days, here's 5 days, here's 10 days, and here's over a month. Clearly, whether I'm looking at sectors, industries, or stocks, you see deterioration over the month. Over the past month, it's been almost 50-50. but over the last 1 and 2 weeks, the market, the industry groups, sectors rather, are decidedly negative. Now, if I rank the sectors at the close of the market on Friday, what you see here is within the Q edge are the different sectors. There's 11 of them. And this tells you performance over 12 months, 11, 10, 9. 1 day performance, communication services, healthcare, discretionary led. Now, communication services was strong, hit a air pocket 3 or 4 months ago. And then it's been coming on strong again, and it was strong pretty much all week. Healthcare, perhaps a defensive play, was also strong for the majority of the week. Discretionary, which had been strong earlier in the year and has gone through a tough patch, picked up, perhaps led by Amazon. What's lagging? Utilities, which is sort of surprising to me, because aren't they defensive? Financials, rates when they go up are good for the financials, but they haven't gone up yet. And staples, so defensive plays, real estate, really lagging. I find that to be sort of surprising. I would have thought perhaps to see strength there. If we look at the top 3, I can highlight those and hit the gears. I bring up the industry groups in the top 3, and you can see leisure facilities, home building, leisure products, textiles, specialized consumer goods, and cable and satellite all make it 1, 2, 3, 4, 5, 6. What you may not realize, 6 of the top 7 are in these groups, and there's 147 groups that are living in this program. So I figured I'd highlight everything above 140, and then I'd hit the peer analysis. When I do that, and there's no way you can see this, don't even bother, I get a list of stocks, rank them by, I think, 1 day performance. And then when I hit these 3 green stars, it gives me a list of undervalued stocks and stocks that have earnings. This is Vista Outdoors. This looked very interesting. The problem with this stock and Storm Ruger and Smith & Wesson, I don't buy gun stocks and ammo stocks, just a personal belief. I'm not making any comments about guns, although I don't know why we need automatic weapons, but that's not my business. I just personally don't have an interest in owning ammo stocks, but they actually are doing quite well. Maybe that's a statement, not what I said, but the fact that ammo stocks are so strong on our current country. Again, I'm not political. I'm not saying you shouldn't be able to have a gun. I just said my personal desire is not to own those stocks. Now, I took Vista Outdoors, I stuck it in the Vital tool. Now, the difference is the Edge tool is limited to the S&P 1500. So I put Vista Outdoors into the Vital tool, which looks at the market as a whole, and it came up with a number of other stocks that would be in the same or similar industry groups. I can see here the valuation in light blue for Vista tells me it's undervalued, has good earnings quality, is a good short squeeze candidate, and look at the earnings per share growth up here. What I don't like is that half these stocks were to the downside, but when you consider that Friday was a 91% stocks to the downside day, the fact that this industry group has 53 of the upsides meaningful. Ran the same thing, got a list of stocks here that are up there, and then when I hit the 3 stars, this group down here is what came up as the undervalued with earnings per share. I think it's a great tool. I use it during the day. It doesn't have all my charting indicators built in, although that actually has happened now with some of the Metastock and TradeStation templates. Here are the canaries. Last week I was relatively bullish on them. They clearly outperformed this week. In fact, I should have pointed that out up here. If we look here, The Canaries were up 1.02% in a bad tape. We talked about that last week, clearly not a surprise. Now, we haven't really broken above the 50-day moving average, so we're still stuck in no man's land, but we had a mobile breakout from the squeeze, and we'll be interested to see if they have an attempt at a breakout. Now, I'm just going to show you something here. This maroon thing is a phoenix. So we're going to talk about the phoenix in a few minutes. That's a thing to put in your feather if you want to be bearish. So know your news and earnings. News clobber the market this week between the CPI, Powell, and other Fed heads speaking. Monday, no news. Tuesday, home sales. Wednesday, some account deficits, PMI. Thursday, some jobless claims, durable goods, revised GDP. And Friday, some income and spending, PCE, and sentiment. I think the market's going to be increasingly looking for signals from the data. If the data gets weaker, rates probably stabilize or head down further. The dollar would probably weaken and the markets go higher. If the numbers show that we're heating up more and longer than expected, then that could be a sign that the Fed's going to taper or tighten sooner, and that will be tough on the market. Not a week without earnings. Some of the stocks that we look at a lot, Plug Power, some of the builders, FedEx, all have earnings this week. So it's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. Just want to call out the Phoenix. Investors Business Daily, William O'Neill have his follow-through day. And there's a specific definition that creates one. When you get a follow-through day after the markets pull back, it's often a sign to get your pencils ready and get ready to buy. We have a follow-through day in HGSI that's calculated with math, and we call that the Eureka. That paints green or blue on the chart. The Phoenix is the bearish version of our follow-through day. It's a turn down day after a market top or a correction is about to come. If the market's already sold off a lot, which is not the case, it could demonstrate irrational exuberance to the downside. You can see the formula here. Some adjustments have been made over the years. But when you see a Phoenix, it tells you there's some weakness in the market. So what are my thoughts? Friday with quadruple expiration date, S&P was down 1.3 on Friday. NASDAQ was down 0.9. You can see the Russell and the Dow fell more. On the week, S&P was down about 2%. The NASDAQ led, but was also down a bit. Fed Powell tried to sound accommodating in the FOMC statement, but the market sold off. And then President St. Louis Fed Bullard, who's been a dove and will be a voting member in 22, came out kind of hawkish. So it seems to me that the Fed is talking up the future so that people are not surprised when they start to reduce some of their buying. Now, there is some interesting seasonality this week that I saw. So it's possible that we could get a run up until the 4th of July weekend starting, maybe not on Monday, but by Tuesday or Wednesday. But we shall see. Things that I think are important is protecting capital. I've pruned back the number of positions. I'll be nimble with a rally to the upside. But I think going forward, the market may become more challenging for the bulls. At times like this, I like to remind myself, cash is a position. Margin is great on the way up, but it can kill you on the way down. My bullish synthetics are great in a bull market. If we're in a bear, I take bearish synthetics. But let's be honest, we're bouncing around in chop. I don't think I'd be taking the short put spread in this market. So I'm not doing many Scott synthetics. You got to be trading faster and holding less positions. Anything that's got a lot of profit in on the option side, roll up and out. And writing calls against positions can help a little bit on the downside. But unless you write your calls at the money, there's a balance between premium and how out of the money the strike price is. You can see despite the last week or two, the markets are holding up well on the year. Now, several of my indicators, you saw the buckets, you saw the T2121. If you look at the number of stocks hitting the low bar or the low jump, a lot of things suggest a bounce might be coming early this week. In my opinion, lower lows are coming afterwards, or like potentially coming afterwards. So beware of a bull trap, and any rally will give a better opportunity to initiate shorts. Now, you're probably looking at your clock and going, does this guy ever shut up? I got to tell you, looking at stocks tonight is a waste of time because it's the market that matters, not the stock picking. Let's go into this real quickly, market force and divergence. Let's just really quickly look at the E-minis. Remember, we're looking at 5 or 6 different things. Are we in a buy signal or a sell signal? We've got a Laguerre RSI sell that came in, I think, on Thursday. And on Wednesday, we had a John Person sell. We had a big red candle on Friday. Remember, these dots were showing you evidence of higher highs, but not higher highs on the MACD histogram, evidence of bearish divergence. Well, what eventually happens? It breaks down. It broke down. We are still in the middle, so we're not at an obvious bounce point. High jumps irrelevant at this point. The weekly bongo took red. This does not look to me like it's a one and done day or 1 in 1 week. And I think we have to be aware that we might see more downside. Remember, these are Alexander painted indicators. The red means I should short or hold. I shouldn't be originating new positions in the S&P 500 to the long side. We're still in a weekly buy and a monthly buy. If I look at the Dow, broken through the bottom of the envelope, doesn't happen often. Typically, we rebound. It would not surprise me at all to see a rebound in the Dow, but a failure when it gets into this moving average might be likely. The weekly is now down, and we got red on the daily and weekly. So the Dow looks horrible. The Russell, new sell signal and a breakdown, new negative Laguerre RSI as well. And then lastly, the NASDAQ. Well, the good news is it's still in a buy signal on the daily and the weekly. But it's got higher highs and it's got MACD divergence. So we're already getting evidence that this isn't all healthy. So it hasn't broken down yet, but it's the last man standing. If I look at the dollar, you can see just a massive move, green bars, so you could be long or holding a daily and a weekly and a monthly buy. I think the dollar might be for real for a while. Hope not, because if it comes down, my stocks usually do better. But the dollar clearly has bounced. Now, I use TradeStation mostly because of sonar and because of the fact, or radar screen, that I can watch the market real time during the day, and I could pull up a number of different indicators. Now, what really excites me, and hopefully this doesn't shut it all down, but if it does, it does, is that Sagar has built in a number of my HGSI indicators for real-time screening. So I may come back to this today on some of the stocks that I like, but you can see it's got pull pocket pivots, mobile breakout, squeeze, kahuna, Bible gap up, ISO failure. He's got a false breakout. Man, he's a great guy. He just does such a good job. I just wish we could put his stuff into HGSI. Such good work from Sagar. All right, let's talk about HGSI. So I always start, again, I look a lot at the market. If you don't like it, you wouldn't be here, because this is what I do. Market, market, market. Here's the S&P 500. Let me just kill the up top because I don't need it. What do I see? I've got a new bongo to the downside weekly. That's bearish. I've got a mobile breakdown from a squeeze, a new John Person sell, a Phoenix, and a Kahuna to the downside. It feels like this is going to go lower. At some point, I'm going to have to figure out how far do I expect it to drop. A really bad drop might be that 38.40. I don't think I expect that. This is the 100-day moving average. It wouldn't shock me to pull further down to here and bounce, but regardless, this thing does not look very bullish right here. And as I said earlier, a snapback might happen and might give us a better spot to short. So that's the S&P. If I look at the Dow Jones Industrial, breaking down, approaching the 100-day moving average. If I look at, notice, just want to call this out, this is calculated on either the NYSE or the NASDAQ. I'm talking about the Phoenix. And it will be the same on every chart because it's not calculated on this specific chart unless it's the NYSE or NASDAQ. So a breakdown in the Dow. Let's look at the Russell. Ditto, red, breakdown here, although it hasn't done much below the 50. It's got person sell, pocket pivots to the downside, huge volume, and kahunas, and that Phoenix. Definitely not a bullish looking picture. And the only thing that looks halfway decent, perhaps, is the NASDAQ composite, which, unlike the others, is still in a John Person buy. Unlike the others, is still above its 50 and a 17-day moving average. So right now, NASDAQ is clearly the best looking in a bad looking market. If I go down and I look at NASDAQ Biotech, broke out above the 100, has pulled back in, has a drop stabilized, and does it go higher? You know, biotech was relatively flat on Friday in a very bad tape. Semiconductors, also something that looks like they want to lead. And you could see on Friday it pulled back, but it just pulled back into the 50. It isn't a weekly bongo to the downside. Did have a down day and had not just a Phoenix, but also a big kahuna to the downside. If you're like me, a growth stock trader, then you may have a lot of IBD 50 stocks. And if you do, your market's not going anywhere, sort of in no man's land between the 50 and the 200, like many of the stocks in the stock market. The FANGs had a better week, and you could see it here closing above its moving averages. We could look at some of the ARC stuff from Kathy Wood. Israel, it's above the 50, going nowhere, but it's above the 50. Next gen, internet, interesting, looks better. Mobile breakup from a squeeze. Pocket pivots, Kuna and person buy. Space, no. Bitcoin there, we don't need to go any further. So that to me is a look at some of the markets. I like to look at the dollar. You know what it's going to show, a rocket to the upside. Took out the 200. And we're not going to look at the VIX, but let's look at gold. You can see gold has broken down below its 50. You look at gold miners, similar. Excuse me. You can look at silver. Pull back into the 200. So they all look weak. All right. Next thing I usually do is go to F7. Give me a sense of the market. 174 index groups here versus 147 in Q, different data set. So let's look at 2-day up. only got 5. Let's look at 2-day force down. 24. So a bearish breakdown. What's in this? Semi devices, electrical power, specialty pharma, entertainment facilities, application software, biofuels. Those are some major growth stock leaders. And notice that on the week, application software was positive, as was entertainment facilities, as was, excuse me, a major move on other financial services. 13-day down, a little bit, or 5-day down rather, a longer look, 88. And if I look at 13 or 5-day up, hardly anything. So I'm going to be careful this week because that is not a very bullish looking list. Let's go back to 2-day up and let's just look at these. Right click, left click, change index group. So Shopify, I made a lot of money on this last year. I'm not currently in it. I wish I was. I know my favorite neighbor was in it this week, although she's not my neighbor anymore. And hopefully she bought enough calls that it made a difference. I don't know if I'd buy Shopify today. It's approaching its prior high, and it's at its prior high. So it'll be interesting to see what happens here. If the market is strong, this is one that you might want to look at. It's extended though. Pinterest coming off its earnings drop. It's working its way up. It's up, so that's something to say about it. Does it make money? Does not make money. Not my cup of tea. Lots of volume. Zillow Group, well, I'm their favorite customer. I look at Zillow starting the day after I move into a house. I didn't put it on my list, but when looking at it, it's got a lot of resistance to get over on these moving averages. But it's had 2, 3 positive kahunas in 5 days. It had a pocket pivot. It is a new John Person buy, a mobile breakout from a squeeze. And we're sideways here and positive on the market catcher. So we got bullish convergence. That actually looks interesting, not a cheap stock. Match Group also looked interesting to me for a lot of the same reasons, except it doesn't have the moving averages ahead. And Matchcom is on my buy watch, as is Fiverr International. Again, a pullback to support, 2 kahunas in a row. Whenever I see that, I get excited. Especially, excuse me, when it's starting to break out. So Fiverr looked interesting to me. Next group was home builders. They had some good earnings out this week. They've sold off, but look at Lennar, 2 kahunas in a row, pocket pivots, John Person buy, mobile breakup from a squeeze, and a Bible gap up. That looks very tasty. D.H. Horton, both look good. Even Skyline looks good. So home builders have some things in it that look interesting. Entertainment, content, Billy, again, very similar to the others, a pullback and now a breakout, mobile breakout from a squeeze, person buy, pocket pivot on volume. I thought this looked interesting. Fox Corp, no. Lionsgate, no. So I always go through the top 10, but there's only 5 commercial vehicles. This one has got so much interesting news. The CFO, the CEO were probably making up orders. They got removed. The stock went up. They still have said they don't have enough cash. They're looking for investors. I don't know why you'd want to be trading that. And it's not in the commercials, but something like NEO, to me, looks a whole lot better if I want to be in the electrical space. And then the last group here, interactive our infrastructure software. It's a gigantic group. OKTA setting up for another run. Like to see it get above that resistance. CrowdStrike, one of my holdings, is just after really disappointing, has taken out to new highs. We'll see how much more momentum it has. It's getting a little stretched. MicroStrategy, a hoarder of Bitcoin, up and down, up and down. I always thought of them as a software company. Now they're a Bitcoin acquirer. ServiceNow breaking out above the moving averages. Excuse me. ServiceNow breaking out. That actually looks okay too. Lots of good looking stocks here. Are there any other industry groups that look good? That was the top five. As you could see, the challenge here is the market. If the market holds up and you get a little bit of a bounce, some of these groups may be leading. I'm going to be very careful with my money. Now, I do have a buy watch list. I saw the controversy. I think for now I'm just going to let you stop it if you want to see what's in the list. And let me just review what this list is. I own a fair number of stocks. When I go through the markets on Saturday morning, I look at over 1,000 charts and I try and find the stocks that look the most compelling to me. If a stock is very cheap or has low volume, I don't look at it. If a stock is $5,000, I don't look at it. If I've already bought the stock and have it in my portfolio, I may not include it. That's something I should fix. But at the end of the day, these are the 23 stocks that I came up with. And for those that have been here before, that is a small number. Let's just go through them very quickly, and then I'm going to say goodnight. This will be a treat. Ceridium HCM Holdings, it's one of the many application softwares. I'd like to see it get above this area of congestion, but it had a mobile breakout from the squeeze. It's in a John Person buy. It's got bullish convergence and two kahunas in a row. Not about the fundamentals, it's the chart. 5.9, which is another application software, is breaking out here. StoneCo, software, I think does financial things in South America or something like that. Sao Paulo, Brazil, about to break out here, and you got mobile breakout from a squeeze, new John Person buy, pocket pivot, and kahunas. And it looks like, no, not a high close doji. Okay, my bad. A couple of cheap stocks. This is Sumo Logic. Why did I like it? Well, mobile breakout from a squeeze. It's above its moving averages. Kahunas and a pocket pivot. Not my favorite chart of the bunch. Twilio, ditto. Zendesk, both Zendesk and Hubs are alternatives to Salesforce.com. Maybe somebody would be buying them. Maybe that's why they're expensive. But you could see market catcher getting better. Stock went sideways. So that's relative strength coming in, and a breakout on Thursday and Friday. Personalis, not yet, but it looks interesting here. It's a personalized medicine, cancer genomics company. Something to keep an eye on. Here is a small biotech, has pulled into the 200, and all of a sudden you got a Bible gap, mobile breakout from a squeeze. You got bullish convergence on the market catcher. You got pocket pivots and kahunas times two. Something's going on with this company. I have no idea anything about them, but I like the chart pattern. Roku, You notice they all have the same pattern. Pull back to support and a breakout. Two kahunas in a row. Earnings are out. I'm learning more about how they make money instead of just selling me the box. I'm going to look hard at this stock this week. That looks interesting. Amazon. Well, interesting story. That is September of 2020. We are at the exact same level right now. So I looked at this, and people who know me and watch this know that Amazon is by far dollar value my biggest position in the market, and that I write calls on it, I buy puts on it, and it's those puts that sort of provide my margin dollars for my trading. All right, so I drew a box over here and I showed how it basically bottom to top, multiple times. Well, it broke out of the top, pulled back, and it's running again. When I look at this, I see the all-time high somewhere around here. Okay, and I didn't mean to have it move. So you hold your shift key. Take your finger off the mouse for the shift key. That is short-term resistance. All right, 40 more points. If we go over a longer period of time, we are at a place that this thing usually reverses. I love it when it goes up because I push my puts up and it gives me more margin dollars. A breakout of those two lines will be massively bullish. A breakout of those two lines that goes up, retests and holds, and then goes up again, really, really bullish. And I am convinced that someday that's going to happen. I am convinced that someday that's going to happen. I just don't know if it's today. So I'd be cautious up here. Over the last 9 months, you've been better off shorting it at the top. But is this the time it breaks out? Don't know. I'm interested enough that it's on my buy watch. Generac. Boy, I hope you bought it at 100 when I said I'm going in Generac. I know some of you did. I wonder if any of you are still holding it because it's gone from 100 to 400 in a year. That's a pretty big move. I'm still in it. I keep rolling up and out my calls. It was hard to stay in it here, but it's running again. Generac. Billy B, one of these entertainment content breaking out. We saw that on the top down approach. Lennar Housing. Splunk. Don't know anything about the company. I hate the chart. It's clearly oversold. It's a big long way run down. But notice the market catcher has gone up and turned positive here. Are we seeing a reversal? The bongo turned green. So what I have here is a bottom fishing reversal. I've made money on these in the past. I wouldn't give it much to run, but at least put it on a watch list and let's see what it does. Told you 5RR this 5R this might be one of my favorites on the board. Not a cheap stock. Match Group, also not a cheap stock. I like a lot. PAGS, this is one of David Gallardi's calls. Internet-based communications, running, maybe not its best buy opportunity. Don't know Two Harbors at all, but I see an 8% dividend. I see a stock that is moving up slowly, that had a Bible gap up the day before, global breakout, a new person buy, and a kahuna, and a lot of volume coming in. Gotta love that 8%. Pool company, again, if this was a $30 stock and it was setting a high base up here at 40, I'd be all in it. It's a $432 stock, so it's probably outside most of ours. Good earnings per share growth, pull back and is breaking out with mobile breakout from a squeeze, a person buy signal, a pocket pivot, and a kahuna. Again, this maroon thing here just tells you that the market's not good. I like this chart a lot. I may still look at it with options. Enphase, we talked about it and run over the last couple of weeks. It's starting its run. It looks very compelling here, and it's not run too far for me to start looking at it. Same thing with Sunrun. I prefer Enphase because Enphase is broken out above its moving averages, and Sunrun still has to do with potential resistance here. AMD, I don't know what to do with this stock. It is running into a congestion area. A breakout above this would have to be considered bullish. It's got great earnings per share growth. And, I can't even tell you how many years I never would consider an AMD chip. And I've got an AMD chip on every one of the machines on my desk. I love their current 5 series, or their 9, Ryzen 9 5950s or 5900s are just phenomenal chips for gaming, which means for trading. And it's stable on TradeStation. Horizon Therapeutics, maybe it's just part of the pattern it's been, but a mobile breakout from a squeeze, a new person buy, a pocket pivot, and a kahuna. This is a really good specialty products company, and they also have good seasonality. Maybe I'll share that with you. Hold on a second. I run seasonality in a lot of programs. I like it in Q. I also like it in EdgeRater. Why do I like seasonality? We're going to highlight this column here. Let's call it green for money. What I'm looking at, and we'll call this has got to be red because it's bleeding. What we see is I took a giant list of stocks, and then I pruned them down over the next month, 8 or more up and 3 or less down. So you're capturing typically 70 to 80% positive seasonality, and then how much of a move does it make? The reason why I'm a little bit less bearish is when I see things like this. Triple Qs are up 10 out of 11 years over the next 30 days with an average return of 8%. Mara, the Bitcoin miner, 8 out of 9 years, 16%. Technology, 10 out of 12, 7%. Google, Facebook, positive. Ultra Pro, S&P 500. So I can't open this thing up. Try that again. There you go. So you got S&P 500 Pro, Bull. Again, not big moves, but at least 8 out of 11 positive. Somewhere in there, I thought I saw Horizon Pharmaceuticals. I guess it didn't make it. because it didn't have enough years. Well, Horizon was on the list. Let's see if I can find it. Now I feel stupid. Unless it was last week that I was thinking about it. Okay. All right, where is it? So it's up 7 out of 9 years. So 72, 73%. And an average return over the next month of 14%. Now, past performances don't mean a darn thing. So I can't guarantee you, nor would I guarantee you, that it's going up because of positive seasonality. I can tell you I made a lot of money because of seasonality. And when I see indexes that are bullish in green over the next month, and then indexes like the SQQQ, S&P 500 short, ultra short Qs, ultra short S&P 500, financial bears, ultra short Dow, small cap bears, ultra short Russell, ultra short Dow. When I see these as being very negative and most years down, that tells me that maybe over the next month we could see another rally. Doesn't mean for sure that we're going to set new highs, and it could be a bull trap. All right, back to the list. Was that the last one? That was the last one. So, just because they're on my list doesn't mean I'm going to buy them. It means they go into radar screen so I can look at them for breakouts, bounces, pullback buys, and then I can also look for kahunas, Bible gap ups, and so on and so forth. So if you have TradeStation, you set up your radar screen, and if you don't have TradeStation, then you set up your Market Watch, where I also have a bunch of indicators. I guess I've overloaded my computer and some of the stocks that I'm watching. I think on that note, I'm going to say goodbye. So let me just say it again. I see bullish signs. I see bearish signs. I see us getting to a point where I expect a bounce. I do not see us going off to the moon and new highs right away. I think we could have a bit more of a pullback before this summer is over. I will look at a rally as a chance to continue to prune some profits and to look at shorting stocks from a better position. Does it have to go up? It doesn't have to go up. We can continue to fall. But I think the odds are that by midweek we're going to see a bounce. And you know what they call a bounce in a falling market? They call it a dead cat bounce. So we could see, and most likely we'll see a dead cat bounce. And if you think about how much cats bounce when you drop them off a roof, not that I'm advocating that, they don't bounce very much. And one last thing, I may catch some heat because of my comments about not buying ammo stocks. I'm not a hunter. I live in a split house where my wife is to the left and I'm to the right. I believe in freedom. I just don't need it for myself. So I'm not making any political statement. I just have made a commitment to my wife that I'm not putting the money, which she likes to remind me is half hers, into ammo stocks. And I'm okay with that. Not saying you can't. And if I felt that you shouldn't ever, I wouldn't have put the stocks up to look at. Good night, everybody. We'll see you next week.